Welcome back to the Plan Future Insight. I am Investment DADA, and today we are going to talk about a question that sits at the very foundation of smart investing. How does market valuation actually impact your money? Let us break this down with the clarity of 20 years of experience. Think of market valuation like the air pressure in a balloon. When it is overinflated, meaning expensive, a small prick can cause a big burst. When it is underinflated, meaning cheap, it has room to expand. Your investment outcomes are directly tied to where we are in this cycle. The core principle is simple. Buying when markets are cheap amplifies your wealth creation dramatically. Buying when markets are frothy compresses future returns. This is not speculation. This is math. Now, let us look at the current technical snapshot. As the live data shows, the Nifty 50 PE ratio is 20.26, compared to its 10-year average of 21.5. Our valuation deviation calculation shows minus 5.77%. DADA says this means markets are trading slightly below their long-term average. Not cheap, not expensive. We are in a fairly valued zone. The 15-day RSI is 51.2, which is neutral territory, neither overbought nor oversold. And the India VIX is 18.38, meaning volatility is moderate, not alarming. The key insight is that we are in what I call the Goldilocks zone. Not too hot, not too cold. Perfect for disciplined SEEP investo. Rupees. Let us move to the descriptive analysis of the current reality. The Nifty 50 is at 24,093, up 0.81% today, showing steady resilience. Mid-caps and small caps are outperforming large caps, which is a classic sign of a bull market broadening. Bank Nifty is relatively subdued, with financials taking a breather. The 10-year government security yield is at 6.77%, meaning bond yields are attractive compared to equity earnings yield. Over the last 20-year rupees, I have seen the Nifty pay range from 12 at the March 2020 COVID lows to 28 at the 2021 peak. At 20.26, we are in the middle third, which is comfortable territory historically. Now let us talk about predictive wisdom with 3 scenarios. First, the bull case with a 35% probability. If earnings grow 15% annually and the PE expands to 22, still below the 10-year median, the Nifty could reach 26,200 by March 2027. The drivers would be foreign institutional investor return, a stable government, and strong GDP growth. Second, the base case with a 50% probability. Markets consolidate in the 22,000 to 25,500 range for 12 to 18 months. Earnings catch up to valuations, and SEEP investors benefit massively from rupee cost averaging. Third, the bear case with a 15% probability. A global recession or geopolitical shock pushes the pay down to 18, and the Nifty corrects to the 21,600 level. For disciplined investor rupees, this becomes the buying opportunity of a lifetime. Here is the beautiful part. Let me show you how valuation timing matters with a 10,000 rupees per month reality check. If you started a SEEP in 2008 when the pay was 12, your corpus would grow to 1.1 crore rupees in 15 years at a 14% CAGR. If you started in 2021 when the pay was 28, your corpus would be only 65 lakh rupees in 15 years at a 10% CAGR. But if you start today at a pay of 20.26, your estimated corpus is 85 lakh rupees in 15 years at a 12% CAGR. The cost of buying expensive is 45 lakh rupees over 15 years. Rupees, that is the real impact of valuation. At times like this, a trusted mutual fund distributor is worth their weight in gold. In 2008, my clients who stayed in regular SIPs through my guidance saw 3 times wealth by 2013. Those who panicked and moved to direct plans excited at the worst possible time. The small commission saves you from lakhs in emotional mistakes. Now, here is what you can do this week. First, set up a 10,000 rupees per month SEEP in a regular large cap fund like SBI Large Cap Fund, a HDFC Flexi Cap Fund. Start today, not tomorrow. The valuation is fair. Second, over the next 1 to 3 months, allocate 70% to equity, 20% to debt via a liquid fund, and 10% to gold via a gold ETF. Rebalance annually. Third, over the next 6 to 12 months, if the Nifty pay drops below 18, which is a medium probability event, increase your SEEP by 25%. That is your buy the deep opportunity. Dada's wisdom is this. The best time to invest was 10 years ago. The second best time is today. But the smartest time is when valuation is fair, and right now, the doors of wealth creation are wide open. Do not wait for the perfect moment because it never arrives. Just start, stay disciplined, and let compounding do its magic. Remember, investment in the equity market is subject to market risk. We do not claim any guarantee of return in equity-related investments. Past performance is not indicative of future results. You have the courage to ask the right questions. Now, go out there and build your future with confidence. This is Investment DADA, signing off. Until next time, stay wise and stay invested. Thanks and regards, Kaustav Bishwas from Plan Future, welcoming you to visit our website. Data and AI driven, your personal navigator and co-pilot for investment analysis.